Let's continue that conversation with the Wisdom Trees. Jeremy Siegel joins us this morning, a Wharton professor. Happy Friday, Jeremy. Good to see you.
Good to see you, too.
Sarah kind of laid it out nicely. I mean, dovish Fed, AI trade, strong forward margins. I mean, some seasonality that's not playing out. Can it stay this good for long?
Yeah, I mean, the trend is still there on an upward basis. I mean, we're getting through, half of September, the end of August, usually seasonally bad, and we've held up extremely well. All eyes, I mean, it's really important, not to next week's Fed, not only what they do next week, but we get the dot plot for what they're going to or intend to do over the next 3 meetings. Because the September meeting is really important because they give an end-of-year forecast, and it really means something in that September meeting because with September and then the 2 further, we will see how many cuts they plan for the year. I think there's going to be 1 cut unless we get very weak retail sales. That's the only, I think, really important data that is coming out before the Fed meeting.
Yep.
We won't get that jobless claims that jumped up until after the meeting, so they can't act on that. If it's very weak, we could push to 50. I expect, by the way, we might see dissents on both sides. Maybe some will say no cut and some will say 50. I have never, for a long time, I think this is going to be the most interesting meeting that we have had.
Especially if Stephen Myron gets in the Fed by Tuesday. I mean, he's set for that Senate vote on Monday. I do wonder if he'll push for a 50. We were talking this morning, having a conversation internally about so a lot's priced in terms of Fed cuts. So what would Powell say? What would it take for the market to rally further and it not to be a sort of buy the rumor, sell the news? And I do think more dissents around 50 could do it because that would indicate that maybe the center will shift toward doing more even sooner.
Yeah.
What do you think?
Yeah. Well, I think some people are saying, if they do 50, it'll scare the market. It means there's a lot of weakness. But, as I've maintained for a long time, the Fed fund should be about 100 basis points under that 10-year. You've been talking about that 10-year. It's, just over 4. That means we should be just over 3, and we should be going towards that. Obviously, 3 cuts over the next 3 meetings will bring us down 75 basis points. Towards the 3.5, a couple more next year. I think the market. A lot of people are saying it's now pricing in 50. I don't think so, but I think one could say maybe a dovish 25, a 25 that opens further cuts.
Dovish tone would be helpful.
I think is pretty much what they expect.
Jeremy, on some of these year-to-date winners, I mean, we've talked a lot about Micron this week, Oracle, obviously, Tesla today up 5% on no news. Do you think instead of like a tax loss selling environment going into year-end, we are going to see a chase where real money just can't afford not to track?
Yeah, I mean, and that year-end fear. A lot of people did the rotation. Oh yeah, the Mag 7 is over. And it wasn't over, or AI is going to take a break, and it isn't. And they may be worried very much about how does their year-to-date performance going to look on December 31st. So we might see AI and the AI-related stocks remain very, very strong to year-end. That being said, if the market believes there's going to be 3 cuts and a couple more next year, I think there's really a good case for that broadening out also. You'll see the small stocks, which are very, very linked to that interest rate expectation, probably continue to do well.
I mean, stagflation is the sort of dirty word. Rick mentioned it on University of Michigan Sentiment, which is weaker economy, higher inflation.
Yeah.
How big of a risk do you see that to the market right now?
I think, in that rate, a few months ago, as Rick mentioned, jumped up to 6. I said that's crazy. Even the most pessimistic forecasters were nowhere near that. I mean, there was a lot of mainstream media hype. These tariffs are going to cause a lot of inflation, and a lot of people, did get scared and that put it in their forecast. This is a consumer expectation. It's not an investor expectation. It's not a business person's expectation. I'm not saying it's irrelevant, but I wouldn't put that much emphasis on that. Also, I mean, basically what Powell said is we can see through tariff-induced increases as a one-time tax and not raise rates or tighten as a result. I mean, that was the pivot at Jackson Hole. So I'm not so concerned about what we just saw in the University of Michigan data.
Yeah, that does remain a debate. Abby Joseph Cohen this morning, not quite there on the one-time pass-through. So that remains something we're going to work through. Jeremy, have a great weekend. Thanks, Professor. Good to see you. Jeremy Siegel.